replacement. This may create leadership uncertainty in the interim period, but there are previous instances wherein, RBI has not been very active with respect to attending the board's call of the duration that has been given to lenders like RBL Bank, Bandhan Bank, Federal Bank as well. And this has led to negative reaction on stock prices. So weak profitability even in FY26 coupled with leadership uncertainty should keep the stock price under pressure is what IIFL Securities has mentioned. Back to you.
IndusInd Bank down 4.5% in trade. Clearly, that is weighing on the stock. The uncertainty, it's a one-year extension, so what happens after that? Then you have to obviously look at succession. So kind of muddles the plot to an extent. The rest of the market, actually, even on the IT, those positive calls that have come in from CLSA, it's not really helped stocks too much. Reliance is also a little quiet. So it's a bit of a quiet start, but it's better than what the implied open was telling us. So let's see if the bulls come in and start buying the dip. Right now, actually, it's looking good. It's just about 16 points down, 19, 20, 30 points down now. So slightly lower on the Nifty. That's how it's opened out. The mid-cap index is relatively better. There's some green on the mid-cap screen so far in the opening, almost actually 0.4% higher. The Bank Nifty obviously is struggling because of the IndusInd Bank hit, but other than IndusInd Bank, is actually not too bad. I mean, other banks are fine, and now there's green on the Nifty, and that's what I was saying. They expect the buyers to come in because the nature of the market seems to have changed a bit last week. The mood is different, and now that elusive buying on dips has started to play out. Now, all the key indices in positive territory, barring the Bank Nifty.
Well, that's right. A few stocks in the broader markets, though, are looking good. You have IRB Infra. The total collection was up by close to around 18%. That stock's flying away in today's trading session, so it's doing quite well, up close to around 3% on rather good volumes. The street likes that. GMR Airports, let's pull up that stock as well. They've acquired additional 10% stake in Delhi International Airport. So that one, I think there was a bit of a positive tick. It's up close to around 1%. Railtel, they won an order of around 76 crores. The street likes that. That stock has opened up well in the green as we speak. The biggest casualty, as you mentioned, was IndusInd Bank. That stock, in fact, is taking it hard on the chin. But we'll have to watch out for this mark because it opened up with a cut of around 4.5%. It's still holding out there. Let's see whether or not there's a recovery in store. A couple of other names. Let's pull up Gensol. The promoter entity went ahead and they sold some stake in the open market. They say that they want to reinvest in the business. Let's see what's the initial reaction out there. The stock is more or less flattish. They have a board meeting in the next couple of days, so we'll have to wait by to hear what are they going to do with their money and how they're going to infuse that in. So that stock, is more or less flattish. Volatile Chemicals, that's one of the big gainers. It's up close to around 10%. I think we need to check in further detail what's going on here. But that stock is one of the top gainers in today's trading session. Big up move. But Reema, I think the positive this morning is the breadth of the market. You have 3.5 stocks that are advancing for one stock that's declining. By the end of today, if you can have a breadth, something like that, well, portfolios will look quite good.
Indeed. Some pharma names are higher in trade. So let's pull up Lupin. That's one. And secondly, even Sun Pharma, where the company has made an acquisition, Checkpoint Therapeutics, which analysts say is a good addition to the company's specialty portfolio. So green on the screen for some of these pharma names. And add to that a Piramal Pharma, which is up nearly 1.8%. In the hospitality pack, you've got Narayana Health, which is up, again, 1.7, 1.8%. So some buying emerging. Blue Jet Healthcare is up 3% on pretty good volumes. So that's one pocket of interest. Trend, on the other hand, is a bit subdued. And I think here Kotak has reduced the target price to 5,150. So the target price cut, some EPS downgrades too coming in for Trend from Kotak Institutional Equities. Castrol, after last week's mega run, is seeing some amount of profit booking. So that's about 2.5% down. But now the benchmark indices have, turned now back in the red now for, but the Nifty is holding 25,500, but it's red.
So the Nifty has been in red. The turn is more on the mid-cap index because that was cruising along quite nicely, but suddenly it's negative. So it's a volatile opening, you'd have to say that. It's not a one-way street, it's quite volatile. And on Trend, I was just adding that Kotak call seems to be a little too late. Stock's already below 5,000 now, and it's gone through serious pain and correction. And that's how it's playing out for the time being. Yeah, IndusInd Bank, now the cut is almost 5%, so let's see. Again, some green on the screen. So it's really flip-flopping. It's very volatile. By the way, there's some correction in large-cap auto names as well. M&M, Bajaj Auto, even Maruti for that matter. Auto is under pressure this morning, along with IndusInd Bank.
A couple of names that are doing well. OMCs, the cooling in crude oil prices, valuation in support, the marketing margins now much higher in comparison to what the street is working with for the next year itself. So HPCL is one stock that's up close to around 3%. Remember, the last few trading sessions, it's moved very, very swiftly and on high volume. So OMCs is the space that's celebrating that decline that we're seeing on crude oil prices as well.
Okay, let's get in Pankaj Murarka, CEO and Chief Investment Officer at Renaissance Investment Managers, on the show now. Pankaj, thank you very much for joining in and good morning. Now, the question is, we've seen early green shoots of a recovery last week. Does it extend, and what will be the nature of the recovery? We've had a slide over the last 5 to 6 months. Is it going to be a very gradual recovery? Is the bottom in place? Or is there a risk of a W-shaped recovery, which means we recover, but again, renewed selling pressure comes in at higher levels and markets trend down? How do you expect the next few months to pan out?
Hi, Rima. Morning. I wish I had an answer to all of this. Market behavior always, is an enigma. All I know is, or the assumption that we're going with is, we still believe that the broader bull market is still intact. Having said that, it's a very matured bull market because this March we finished 5 years, the bull market started and onslaught of COVID. So it's a very matured bull market, but we still firmly believe that we are very much in a bull market. The correction that we've seen over the last 5 months is more a correction in a bull market. And from a market direction perspective, our broader sense is that somewhere we are closer to a trough in terms of aggregate as far as the large cap indices or Nifty index is concerned. Probably markets will consolidate at these levels for the next few months before we make the next move up. Having said that, I still believe that if you look at last year, CY24, the Nifty index did about 9% return on a full year calendar year basis. And we still think that given that we are in the midst of a cyclical slowdown, the economy and earnings slowdown, this year Nifty 50 earnings growth is just about under 5%, probably the weakest earnings growth that we've seen in the last 5 years. I think the returns this year could be as well into single digit at the Nifty 50 index level. But I think more importantly, what we had seen was a fair degree of fear in market over the last 8 weeks and a significant unwinding across the market. The breadth of the market was very bad. I think that one-way selling across the market probably will take a pause, and from here on it will be more fundamental driven and stock specific. So there'll be a wider dispersion in the behavior and performance of stocks, I think. But I think the broad-based sell-off is done, and probably my assessment is that probably as far as the Nifty index is concerned, we have made a trough because now valuations are at about 10% discount to the last 15 years averages, which is very comforting. And more importantly, we see growth picking up in the second half of this year. So probably growth in the second half of this year will be much better than what we've seen in the last 15 months.
Okay. Hi, Pankaj. Good morning and good to see you. When there's been this debate whether or not we're going to get into a sticky territory, and some people are also calling for a bear market. Clearly, going by what you're saying, you're not in that camp. You believe at least the headline index, where we seem to be hit, making a bit of a bottom in place. Is that correct, right?
Absolutely, Nigel. I'm not in the bear market camp. I think we are very much in a bull market. The only caveat is it's a very matured bull market. At a point in last year, September, at index at 26,000, valuations were rich. We have been over the last 15 years the most expensive equity market in the world. In the most expensive equity market in the world, where valuations are rich, and when you get an economic cyclical slowdown in the economy and earnings slowdown, markets will correct. And which is what exactly we've seen in the last 5 months. Having said that, I still believe that the broader bull market very much remains in place.
Okay, let's talk about a couple of sectors then. I think you like the discretionary spends, right? And I think you were talking about last time around, we're talking about happier things. Pizza, whiskey, Jubilant Foodworks, United Spirits. Now, the hope is that rural economy comes back because of, what's happened in the budget. And because that's seen a fair bit of pain as well. How are you positioned now on the consumption theme?
So, absolutely, Nigel. In a gap of almost 4 years now, I've started in consumer as a sector. We've been underweight consumer as a sector for almost 4 years post-COVID. But we think we've reached a point. If you see the last 2 years, the PFC, the private consumption, has been growing at about 6%, which is half of the last 10 years average. The last 10 years, PFC growth has been about 11-12% and has been ahead of nominal GDP growth. The rural consumption slowdown in India we're already 2 years into a rural slowdown because the rural consumption started slowing down in June 23. But I think we've reached a stage where we are at a very low point of consumption. Most of the headwinds are behind us. And more importantly, we see some green shoots, I would say, of revival in consumption. They're still early days, but I think we're seeing those in terms of early revival in some segments of pockets of rural consumption. And more importantly, the government itself has made a pivot this year. We've seen in this budget, the last 4 years, significant part of government resources were allocated towards driving central government investments. And this time, the budget has been a more balanced budget across investments and consumption, and started with a tax break. Over the weekend, the finance minister is talking about GST rate cuts, I think, which is very important because high inflation has had a really impacted consumption in the last 2 or 3 years. So probably that will be very helpful. So I think we are in an early stage of a consumer recovery. I think the recovery will gather momentum going into the second half of this year. So if on an aggregate, meaning when I look at the market, probably consumer as a sector looks probably the most promising to me across sectors within the markets. And within that, our bets are placed across both staples and discretionary. So while on discretionary, we like some of those stocks, including Jubilant Foods and United Spirits, we like staples as well because we think that staples will see recovery as well as rural consumption improves.
What are the other big portfolio calls you all are making?
So, Rima, at this point of time, the approach is slightly, meaning while that's not an approach, but the way it comes up as investors, we are bottom-up stock pickers. So, what it comes across is our portfolio is looking more contrarian. We like financials, and within that, private sector financials, again, a sector which has not done well for the last 2.5 years. And some of those boring names like HDFC Bank and Kotak Banks are really now our favorite ones because we think the headwinds that these companies had over the last 2 or 3 years are behind them, and probably they will lead growth recovery going into the next 3 years. Valuations, the stocks having remained flat almost for 3 years or 4 years, valuations are far more compelling and are significantly below where these stocks have traded over the last 10 or 15 years. And so we like private sector financials along with consumption. And we continue to remain positive on IT as a sector because we still think that despite a tail risk of recession in US, discretionary spends in US towards IT will keep increasing through the course of the year.
Any thoughts on Innocent Bank and the news flow? Because you'll analyze private sector financials across. While it's not your favorite or preferred pick, it's HDFC Bank and Kotak Mahindra Bank. But your thoughts on the developments?
Well, so we think the probably HDFC Bank is in the last leg of dealing with the challenges of absorbing HDFC as a conglomerate because it's been now 8 quarters into it. It was one of the biggest M&A that we have seen in the financial sector, even from a global standards, at $90-odd billion. And when you do such a large M&A, it does take time to digest, absorb, and integrate. HDFC Bank, to my view, has gone from being the fastest growing private sector bank of India for 20 years to being the slowest growing private sector bank of India in the last 3 years. I reckon, or we believe that probably in 3 years' time from now, it can go back to being the fastest growing private sector bank in India. And if that be the case, then apart from strong earnings growth, I think HDFC Bank's valuation, which have got derated over the last 3 years, will again will get re-rated. They might not go back to where they were because historical growth rates will moderate going forward, but still we see significant valuation uptake in HDFC Bank from here on.
I was actually asking on Innocent Bank.
Oh,
any thoughts?
Not really, meaning we do have thoughts, but it's not one of our preferred bets, Rima, in that sense. We don't own that. As investors, we are moderate risk investors or low risk investors, and we usually don't like banks which have significant exposure to microfinance as a space because our experience over the years has been that every 5 years you get some very significant credit costs coming into that business. So we've stayed away from banks which have significant exposure to microfinance.
Pankaj, hi, morning, Surabhi here. So I guess the big issue with the street is buying large caps is fine. Most people are saying that it's relatively safer to buy large caps, right? The issue is that should you venture into mid caps at all? And if yes, which are the pockets that are looking, well, relatively safe, where there's some growth, where valuations have cooled off as well? I mean, what's your thought? The whole large cap versus SMID debate. And what would you buy in SMIDs after this correction?
So I think one should definitely invest into mid and small cap, but I think at the index level, I still think that this year the large cap, unlike the last 2 years, 2023 and 24, the mid and small cap index outperformed the large cap index. Probably this year could be a year where the large cap indices outperform the mid and small cap index. Having said that, it's not that mid caps or small caps will not make money. The only point I'm trying to make is that unlike last 2 years where every stock in mid and small cap made money, from here on it will get more stock specific. So the dispersion within the index or within the group of mid and small cap will increase very significantly. So one will have to be very careful in terms of picking the right stocks. And when it comes to mid and small caps, because these are companies which are mid-size or small size, those sector approach doesn't work as much because you have to get the business model and the management right. So bottom-up stocking plays a more important role. Having said that, we still like, meaning some of the companies I mentioned, like Jubilant, we are betting on revival and discretionary consumption. So Jubilant Foods is a classical mid-cap and a caveat. We own that in our portfolio, so we like that. Likewise, we like some of the other names on the discretionary consumption side because I still believe that we'll see a recovery in discretionary consumption over the rest of the year as well. The CRAMS story looks still pretty promising. Most of the CRAMS companies in India in the healthcare space are still mid-caps. We don't have a large. I think probably in 10 years' time, we'll have a company from the space which will be large cap. DVs is there, but I think there'll be more companies which will emerge because the opportunity size out there is very significant. So some of these mid-cap CRAMS companies look very promising.
Okay, fair enough. Yeah, I mean, intrinsically, I'm sure big opportunities over there. It's just that it's a very, very complex and confusing landscape with so much of tariff talk. But take your point. Thank you, Pankaj, very much for joining in and giving us some perspective on the market. The market, by the way, which continues to be fairly volatile. It's flip-flopping between red and green, but there is plenty of green also on the screen. So that's the good news. Nifty is up 30 points, so not bad at all. The first dip has indeed been bought. But now we're coming back to that central issue of US tariffs and what that is going to mean for Indian companies. Like we told you just a while back over the weekend. Again, we had very, very sharp statements coming in from Mr. Donald Trump saying that it's impossible to sell anything here in India. And then we had the US Commerce Secretary saying that everyone must make in America. It doesn't matter how much is the cost, whether you get robots to do it or humans to do it, but make in America. Don't ship things into the US. Where does that leave companies that have reasonably high exposure to the US market? Well, we're putting the spotlight on one such company. Right now, I'm talking about Vinati Organics. Now, interestingly, Vinati has decided to set up a wholly owned subsidiary in the US. To talk about this and more, we have with us Vinati Saraf Mutreja, Managing Director at Vinati. So, Vinati, great to have you, with us. You tell us, is it just a coincidence? Were you always planning a US subsidiary all along? Or is it sort of a bit of a response and maybe a need of the hour, given the new dispensation, given what the new US administration wants? Tell us more about the US plans. I think out of your total exports, US is almost 36%. Out of your total revenue, correct me if I'm wrong, but US contributes 20%. So that's pretty significant.
Sure. Good morning. So I think, like you rightly pointed out, it is actually just a coincidence. We always needed to have a subsidiary in the US, simply given because it's such a large market for us, and we do export a fair bit to the US. A lot of our customers want us to have a warehouse in the country itself, so it's easier to distribute products. As far as the tariffs are concerned, I don't think as of now it affects us too much. It only affects us in products where there is local manufacturing. But if you look at our top two products, for example, IBB or ATBS, there are no manufacturers in the United States for those products. It's manufactured in China, and China has a tariff already. So anyways, for the last 4 or 5 years, we've had an advantage supplying to the US. And I do believe going forward, that advantage will sustain for these products at least.
Vinati, just tell us how the dynamics were working till now for the business. For your exports to the US, which is 20% of revenue, what was the kind of duty that was involved? I mean, just explain the dynamics. How was it working up until now? And now, how much of that business is going to move through this wholly owned subsidiary, which then, it becomes absolutely tariff-free, in the sense it's tariff agnostic, fully protected then?
No, I don't think, first of all, I don't think the subsidiary becomes tariff agnostic, because there is going to be transfer pricing involved. So the subsidiary is not a way to avoid tariffs. I don't think that is possible, and that is not the intention also. The subsidiary is simply there to better service our customers in terms of distribution and having a local warehouse. And maybe if we want to do some sort of product customization or small synthesis, if at all in the future needed. It does not circumvent the tariffs in any way.
Means you're still exposed, Vinati. That's an important clarification. You're right. I mean, then that means there will be transfer pricing at play. So what is the blended tariff right now that's applied to, to the products that you're selling into the US markets?
So it depends on products. It's a basic custom duties that they impose on products, maybe 7%, 7.5%. That's what it is as of now.
Okay, so the US, you're not going to manufacture in the US. You never were manufacturing, and even with this new subsidiary, it's only going to be warehousing and maybe some customization. No manufacturing takes place out of US, right?
Absolutely correct. That's right.
Okay. Now, the US has increased tariffs on imports from China by 10%. Does that change the dynamics for you in your business line?
Well, it should. It should make us competitive by 10%. So let's see. And honestly, this quarter is looking good. The next year is looking good. I'm not sure how much of this is because of tariffs. It could be just a general market situation. It could be just a general. In general, our expansions are coming on stream. And please realize we are into niche chemicals, specialty chemicals, where we are market leaders, and there are few competitors. So a lot of these tariffs don't have a real effect on our products.
So just clarifying that blended number, Vinati, that you shared right now, blended imports into the US, that's your products. The blended tariff is about 7.5%, right?
That's right.
And you would know how the supply chains work. So since it's all about reciprocal tariff, what they're saying is that we will tax you as much as you are taxing us. I don't even know if you're importing. I mean, what would the reciprocal rate be with India? Is there any threat to that 7.5%? Moving, higher?
Again, maybe we do buy most of our raw materials domestically. Again, domestic suppliers also price it on import parity. So if there is an additional duty, I'm sure the domestic suppliers will take advantage of that and pass it on. But we also import a lot from Korea, from China, from other countries besides US. So on the whole, I am not worried about this tariff situation, at least in my business, whether it's from the supply side or the sales side.
That's good to hear then, Vinati, but you're sounding quite optimistic about Q4's numbers as well as on FY26 prospects. So that clearly means that on ground you have seen some kind of pricing improvement as well as you believe that demand will be fairly firm. Give us, without getting into numbers, for Q4, if you compare it with Q3, how has pricing improved, if you could quantify it, and demand strong?
Sure. So pricing remains stable. We have long-term contracts, formula-based pricing, where we pass on the raw material increase or decrease to our customers. But the demand is looking strong, especially for ATBS. Again, coming to antioxidants, the new products, the demand in India is growing, is growing quite a bit. Butyl phenols, we are running at 70-80% capacity utilization. My new plant is very much ready, and the product is getting approved for the other specialty products, which goes into polymers. So on the whole, our product portfolio is increasing, our product mix is changing, and that is where the optimism is really coming from. My new plant for ATBS as well is about to get commissioned and get ready, where we're already oversold.
Okay, all right. Then now let's get to numbers. Tell us, FY25, we let it skip because, you would be in that silent period. But on whatever you deliver in FY25, given the kind of demand you've seen, given the fact that pricing could have bottomed out and you have expansions coming on stream, what kind of revenue growth are you working with? What kind of profitability margins?
Sure. I think one can expect about 20%, maybe 15 to 20% revenue as well as EBITDA growth in the next 2 years, 2 to 3 years, year on year.
And in the past, you've spoken about 26 to 20% EBITDA margins on a sustainable basis.
26%, yes. 26, 27% EBITDA margins. That's right.
Okay. And all your capacity expansion, is it on track?
So far, yes. So far, so good. Fingers crossed. Yes.
Okay. And what about competitive pressures? Investors are a bit concerned on if competitive intensity is picking up.
If the demand is growing, then we are all, taken care of. I'm not worried about competition. Yes, we do face competition from China in antioxidants. That is one product which is being dumped into the country simply because the demand in India is growing. And we have applied for some sort of relief from the government, but let's see if that happens, does not happen. That's the one product where we do see competitive threat, yes.
Vinati, I'm glad you brought this up because I wanted to actually come to the whole China angle as well. It's all globally linked, right? So you're saying on one end, on antioxidants, there is some dumping happening. So the industry is asking for what, a safeguard duty of sorts? What is the kind of tariff protection that you're seeking?
Yeah, we have requested for an anti-dumping duty.
And what level would be suitable or required, I mean, to give adequate protection?
Could be anywhere, 20% in that range, give or take.
Okay, 20% anti-dumping duty for antioxidants which are coming in from China. Just to come to the
it's still under process. It's still under process, and it will take
discussions.
some time.
Absolutely, yeah. It
What's
has to be
the
taken up.
feedback from the government on this anti-dumping duty proposal or request from you all?
No feedback. No feedback yet. We have applied, and we are just waiting for them to review and take their decision.
Okay, all right, Vinati, just leading into our next conversation, we've got a fair idea about your business. What about global freight rates? How have they moved? If you could give us for your business, just some color.
Well, so freights have come down in the last couple of months. And again, we pass that on as well to our customers. So whether it is raw material fluctuation, freight rate fluctuation, it really, we are agnostic to that volatility.
Okay, Vinati, always good to speak to you. Thanks a lot for joining in, giving us sense in terms of your business. And since we have ended that on the freight situation, I'll tell you what, we'll slip into a short break. On the other side, we'll focus on GE shipping. That's the next management on our radar. But as we slip into a break, here's a quick note for our viewers. The conversation around gender parity and closing the gender gap is evolving, and so are solutions. HSBC presents CNBC-TV18 Future Female Forward Mega Summit, co-presented by Cognizant, where industry pioneers share their take on what's next. Tune in to the discussions that drive the real change today at 5:30 p.m. onwards.
Welcome back. So we've got some green above our heads, as you can see, and we are pretty pleased with that. Like Nigel said, we just ended that last conversation with Vinati Organics to talk about, what's happening in terms of global freight. So let's actually get a deeper dive into it. How is the shipping sector coping with all of this tariff talk and the fact that crude oil prices are sort of reducing? This geopolitics as well. We woke up to the fact that there are new threats to Mr. Putin with respect to sanctions from the US if there's no agreement on Ukraine. So it's really everything is happening over here. So what does it all boil down to in terms of charter rates, whether it's tankers, whether it's bulk carriers, and what's happening in the shipping market? How's demand supply? Let's ask Mr. G. Shivakumar, Executive Director and CFO at GE Shipping. Mr. Shivakumar, you're already smiling, I think. It's complex. It's a complex world, right, that you folks are navigating because there's way too much going on. So I just want to start with the basics first. Has there been over Q3 so far into Q4, has there been some stability or any hint of a recovery when it comes to basic rates? Just tell us how they've moved. I think, crude carriers were at about $30,000. That's the last figure we had. Is there any upward momentum at all now that Donald Trump is saying drill, baby, drill?
Morning, Surbi. Yeah, I think it's a little early to expect an impact from those statements. Eventually, hopefully, it will result in more export cargo of oil coming out of the US. For now, there's no impact yet. Again, it's probably a function of the oil price, and maybe they need a higher oil price to be motivated to drill more and produce more oil. For now, there's not much change in rates between the previous quarter and this one. Maybe marginally lower on average across all tankers. Bulk carriers are a little lower again, but bulk carriers is more of a seasonality. Typically, the first quarter of the calendar year tends to be the weakest quarter. So it's been weaker than the previous quarter.
Can you share some numbers, sir? So if you're saying tankers slightly lower, then how much lower than 30,000? And where are bulk carrier rates now? Some rough range to help us?
So crude tankers are more or less where they were in the previous quarter, not very different. Product tankers are probably marginally lower. Bulk carriers are also a few, maybe $3,000 to $4,000 lower on average. Again, the big ships are much lower than they were in the previous quarter, the Cape-size bulkers. The smaller ships, maybe $3,000 a day lower. In the tankers, the product tankers, maybe a couple of $1,000 here.
Got that. So slightly lower, quarter on quarter.
But year on year, they are much lower.
Year on year, what would be the decline?
So we're talking $10,000 to $15,000 a day on tankers, maybe $5,000 a day on average for bulk carriers.
Got that. Important numbers. So wanted to get your views on another proposal that's come out of US President Donald Trump about imposing fees on Chinese-built vessels entering US ports. And that's raised concerns about higher shipping costs, inflation. Now, considering that China dominates global shipbuilding, how do you expect this to play out?
So again, this is, as it stands, this is a proposal, as you said, Rima. And it's going to go through a process. I think they've invited comments, and it's going to go through a process of public hearings, which will happen in the next couple of weeks. So we'll wait to see how finally it pans out. It looks like something that will be tough to implement. It's something, if it is actually implemented, I suppose it will result in significantly higher costs of freight going into the US, because as you said, there are a lot of Chinese-built ships there. Even if they, ship owners divert their Chinese-built ships elsewhere to save on these costs, it just means that the whole supply chain becomes less efficient. Less efficient shipping means tighter markets, higher costs. So net, this is one of those things that could potentially result in higher freight costs.
Okay, potentially. But just, we know China dominates shipbuilding, but to what extent are we talking about? Do we have any numbers?
On the current order book, I think they have a majority. They probably have 60%. The order book is mainly between China, Japan, and Korea. Okay. They have the majority. I think they have almost as much as Japan and Korea put together of the current ships under construction. So they have a very, very significant majority. Yeah.
So it'll be a significant impact. And I know now it's a proposal, but do we know what's the extent of fees that the proposal entails?
Yeah, it goes up to $1.5 million per ship per port call as it stands, and which is a very big number, really, which is proposed. And the enforcement is going to be tough because it depends on several factors, including how many Chinese ships the company owns, how many ships Chinese ships the company has on order. It's a complicated thing.
Indeed. But do we have any, have you all thought of any kind of contingency, any plan B in case it gets implemented in any form and shape? May not be $1 million, $1.5 million in terms of fees. But what is the thought process on how will the company navigate this headwind?
So a pretty small portion of our fleet is actually Chinese built. Most of our ships are built Japan and Korea. So we only have 5 Chinese built vessels, really. So it's not, all you can do is to avoid putting them into that trade, because then it just becomes more expensive. So we'll just have to, if it comes through, we'll have to see how to trade those ships. And as I said, as soon as you introduce this new condition into the trading patterns, everything becomes less efficient, which means that, just ships make more money when things become less efficient.
All right. Hi, Mr. Shivkumar. Good to see you. And as always, the last time we chatted, we were talking about ship pricing going down by, I think, 15% or thereabouts. But at that point of time, you said it's not yet attractive. Now you have a clean balance sheet. How do you navigate things? At what time do you decide that it's time now? You need to put that cash into works and, in fact, buy some ships. That time has not yet come?
Morning, Nigel. Yeah, the time has not yet come. The prices are where they were when we last met a month and a half ago. Not very different. So we are not yet there to buy. And of course, now every day you have some added uncertainty around US tariffs, trade, etc. So I think it makes sense to wait for a bit.
You know, on the point of US tariffs, Mr. Shivakumar, I mean, common sense would say that it should not really impact maybe shipping rates too much, right? It's a question of how much more tariff you have to pay. But then, yeah, it's still negotiations, so it perhaps delays shipments. Maybe you start doing trade with different trade partners, and that starts impacting routes and lines, and then therefore overall freight rates. I think second order, third order impact could be there. But you're best placed to tell us what is happening right now in the seas, and what do you see ahead next couple of months?
So we saw this play out in a small way in the last term of President Trump, where there were some China tariffs put there, and China put some tariffs on US products, which they've already done, where they put some tariffs on US grain. And US is a significant exporter of soybean to China. So when those tariffs came in, basically the trades rerouted. China imported from Brazil, Argentina instead of the US, and US, instead of exporting to China, exported elsewhere. What happens is that it makes the trade just a little bit less efficient. And therefore, if anything, it's got a positive impact on the market, as you said. The concern is if there are widespread tariffs, then it actually affects economic growth and underlying demand for the commodity, in which case that becomes a negative. On a ton-mile trading pattern basis, it's good for shipping. But if it affects demand for commodities, then that's bad for shipping because of general economic impact.
So as of now, it's net neutral, right?
It's neutral for now because there are no tariffs on oil, and the tariffs keep coming on and off on Canadian and Mexican oil, which is a big trade. And if Mexican or Canadian oil can't go to the US, then they have to go much further afield, which is good for tankers in general. So, but those have been kept in abeyance till the beginning of April. We'll see then what happens to that oil and those tariffs.
Thank you, Mr. Shivakumar, for joining in. It's an uncertain terrain that everyone's navigating right now. By the way, look at the markets go. After a flat opening, it's picked up. The Nifty is now heading towards 22,650, 90 points up on the Nifty. Sensex up close to about 300 points. So continuing with the recovery from last week. Mid-caps holding up in the green. Banks is still on the flatter side, but green tick. But it's PSUs dominating trade today. The Nifty CPSC index is nearly up 1.6%, and metals are adding on to the 8% up move from last week. It's added another 1% early in the morning, this Monday morning. So metals are higher in trade. Power Grid, Bajaj Finance, Adani Ports, BEL, Bajaj Finserv are some of the big movers. But let's talk about the real estate picture. Now, Mumbai has recorded over 11,500 property sale registrations in the month of February. Bowman Rustam Irani, Chairman and Managing Director at Keystone Realtors, is now with us on the show. Thank you very much for joining in. So the numbers from Knight Frank continue to point to a very robust and resilient Mumbai market. But I think that my first question is, are we seeing any kind of impact on account of the decline in the stock market prices, the negative wealth effect that we say? Is that hurting maybe the luxury apartments, maybe something that someone was comfortable buying at 30 crore would say that, well, I've lost so much in the markets now, let me go out there and buy a 20 crore flat now. So the premium, ultra high luxury kind of apartments, has there been an impact of the negative wealth effect?
Good morning, and thank you for having me on your show. Look, I've been fielded this question plenty of times before, and I'd like to just state that the numbers do not point towards what you are saying is a possible outcome of the stock market being brittle or coming down. We've seen 11,820 registrations, value of about 918 crores from the stamp duty that we see that is collected by the state. And this is just a tad down from 994 crores collected in January. But we must remember that February had less days, and this February particularly had 2 days lesser in terms of the working time given to the market. So if I was just to extrapolate, if we would have crossed 12,000 700 odd registrations for the month, and the collections would have been way in excess of even January. So while there is a general feel that the stock market will continue to, loom and bring down the sales numbers of real estate, I do not see that happening as of right now. As a matter of fact, the homes that we see selling at max even today are those that are priced at about 5 crore rupees in the Mumbai landscape itself. And we are seeing a healthy and robust sales so far. I just spoke to my sales head for the month of March. In the last few days, we've seen a good uptake. People are looking at or are looking for new launches taking place, and there's always a buy-in over there because people look at the best price available when a new launch comes into play. So overall, the markets seem good and seem counterintuitive to what you've been saying that could happen.
What about pricing? Because we've seen a consistent, steady price increase over the last couple of years. Has that trend continued? What's been the pricing like in the month of January and February, and the expectation for calendar year 2025?
So again, the pricing, there has been no, we believe that it's better to have a robust growth in velocity rather than just the prices. And developers, especially in the mature markets, have understood that. The reports that you will be talking about lead towards, about a 6% growth in prices in the last year, in the entire last gone by. This is in Mumbai specifically. In Thane, the numbers are slightly more higher. And then when we look at the country as a whole landscape, or Maharashtra as a whole landscape, we've seen prices appreciate by as much as 11 to 14%. But Mumbai and MMR generally are a little more toned down. Between 6 and 9% is where we see the prices going. I do not think we should aim for higher prices. I think we should continue keeping prices in check so that people are able to continue affording the home of their choice, and there is a home for all, which is exactly what we've been working towards.
So that's 6 to 9% price appreciation. That is to be expected. Are you talking about the next 12 months or so in Mumbai MMR?
I actually always speak about the data, so it's past.
This is a past trend. I thought that's a projection that you were giving. So let me ask you for the projection then. In the past, Mumbai has seen about 6 to 9%, but now with the markets and the sentiment, etc., what do you see ahead for pricing in Mumbai MMR?
I would like to just give you some more data, if that's okay with you. The general acceptable or healthy overhang of inventory should be at about 24 months, okay? When the market prices start appreciating, this is because this overhang is less than 24 months. And as of right now, data shows that we've got about 18 months of overhang in terms of unsold stock in Mumbai and MMR. So this does lead to some kind of speculation of price increases, but fortunately these price increases are kind of kept to very micro markets. So certain very small micro markets might see a bigger spike, but on the larger base, I'm hoping at least that prices do not kind of escalate beyond the 6, 7, 8%. That is the inflationary trend that we see.
Baman, even the customers will be hoping that it doesn't escalate because you're seeing demand is solid. They'll be saying prices, hopefully it doesn't get too expensive. But tell us, what about the affordable market? You're not leaning too much towards that, but as an industry, there seems to be some pain out there. Would you agree?
I would agree with you entirely. The affordable market is not being addressed the way it should be addressed at this moment in time. And we've said this before, there are no margins, especially in the affordable space where developers would find it, incentivizing enough to be able to go ahead and address this market as such. So overall, we would like for a few changes that the government, we've been reaching out to time and again, and asking for certain softs for not developers, but for the purchasers. And if those come through, then we are hopeful that the affordable market will be something that's great. But one of the key things that we've been asking is this 45 lakh cap that has been put as the tag price for an affordable home has been put in 2017. And if you just take normal inflationary trends, Nigel, that should be in the region of about 80 lakhs plus as of right now. So an affordable home should be tagged ideally only on the size of the apartment, and not on the price point of the apartment. And even if it's a price point, there should be a distinguishing between tier 1, tier 2 cities and the rest. But I'm happy to state that in the rest of the country, and we've just come back from a CREDAI New India Summit, which is where we address the emerging markets, because that's where India is really growing as of right now. The Viksit Bharat is really happening. My conversations with most of the developers out there, they saw a good and healthy growth in infrastructure in their areas, leading to an additional buying or a greater buying taking place out there. Again, I do not have an answer for affordable housing there, but affordable housing definitely needs to be addressed by the government first, and then at the same point of time by the developers too.
For Mumbai, Bhavan, I don't know. Affordable housing would be described as what, 3 crores of late? I'm not sure. It's one of those markets, right?
I can tell you what we need to do. We need to be able to kind of improve transportation timelines. So we've just launched a project which is in Dombivli, and I can say this, that the demand has been pretty good. The buying enthusiasm has been high because Dombivli, Thane are a distance which is about 35-40 minutes, and Thane is seeing a lot of growth in their commercial development. So people who live in Dombivli can go to work in Bhiwandi, can come to Thane, and that is why, you know, Bhiwandi is a new and upcoming area. Connectivity is improving. If we increase or improve the connectivity between the suburbs and the city, or the places of commercial development move towards these places, you will see a good and healthy growth out there. Let me just give you a price point, and that would be in the region of about 75 to 80 lakhs. You can afford to get a proper home in the Dombivli market. Even today, Virar sells a 1-bedroom at about less than 50 lakhs and a 2-bedroom at about 75 lakhs. So it is possible to address these markets, provided the transportation or the infrastructure that we are seeing, or we see happening, can just be speeded up and happen quicker.
Last mile connectivity is still a bit of a problem, but thank you very much for joining in. Let's get to the markets and get in a few technical ideas as the markets are racing away higher, 0.5% up now on the indices. Mitesh is now with us. Mitesh, good morning so far.
Very good morning, Rima. In fact, the Nifty aided by, I think, if you look at the stock price movements, it's Reliance, which has done well on Friday as well, some FMCG names and the Adani Group stocks. So I have buy calls from there. On the Adani Group, I think, Ambuja is something which has caught my eye. So Ambuja Cement is a buy. Keep a stop below 490 for half year and look for a target of around 540 on the upside. And Godrej Consumer is what I've chosen from the FMCG pack. I think that's a stock which I would recommend with a stop just below levels of 1,040 and look for a target of around 1,080-85.
Thank you very much for that. Get into a break. On the other side, we'll talk commodities with Manisha Gupta. Stay tuned. Welcome back. Let's shift our attention now to the commodity markets. Manisha, as promised, is with us. Manisha, what are you tracking?
Well, I'm looking at metals as a sector, and you know, the last week was really good when you saw many of those metal prices there, but we haven't started on the same note on Monday morning right now. So when you look at the copper prices, we are off those 9-month highs. The prices have seen a decline of nearly 1% in the Asian markets right now. Well, there are various factors to watch out for, but having said that, even with this decline, copper prices still are 17% up in 2025 till now, and the markets do believe that the first quarter is going to be on the higher side there. I want to start talking about tariffs first, and that really seems to be adding a lot of uncertainty into the markets, but it is the US non-farm payroll data that the street is also reacting to. So what the markets were anticipating, you have lesser numbers than that, and that has led to a very sharp decline in the dollar index there. We're trading at a multi-month lows on dollar index, and that should have supported many of those metals, but that clearly is not the case right now. So coming to tariffs, and that really is the moving factor right now, rather the uncertainty therein. The Trump's shifting trade policies have given a rise to uncertainty in case of economic growth, and that has led to a lot of arbitrage opportunities in the international markets as well. So at this point in time, we have US suggesting that they have eased some tariffs when it comes to Mexico and Canada, and then the US also has ordered investigation into potential tariffs in copper imports. It takes, we are told, nearly a month by the time you will have those reports coming in. It already is 2 weeks down, so the next 2 weeks really are going to be important when it comes to copper there. If you look at the US markets, well, US imports 45% of its copper requirement. So whatever tariffs and what all tariffs we see is going to be important to understand. And copper, remember, is very important when it comes to EV, AI, electrification, data centers, and the conventional uses for copper also continue to be quite strong there. Well, apart from that, you have to take a look at China as well, where we have seen producers now sell to lock in profits. Is the reason that after very strong gains that we saw in copper, there is some profit-taking opportunity as well arising right now. The Chinese consumer prices also declined for the first time in 13 months. China trade data for the month of Jan and Feb also hasn't been so strong. We've seen imports decline, exports lose momentum, and as far as the US and China trade deficit goes, well, we have seen that surplus grow with US in the markets there. So it's various factors really that the street will be watching out for right now. The copper demand in the meanwhile, as I told you, has been on the stronger side. We are looking at copper deficit stories for the next couple of years in sense of anticipation there. That would support copper prices going forward. When you look at the Chinese markets, though, we have seen a lot of tangible commodity buying continue in case of China. So copper inventories are high in China. But when you look at the US markets and LME, the copper inventories there have continued to decline. And more importantly, with the way the tariffs are going and because US doesn't have enough copper, the US copper prices are trading at a 10% premium right now to LME. So that tells you the story. And this vagary or this disruption in sense of prices is something that the markets are anticipating to continue for the next quarter as well.
Thank you very much for that. Let's talk about some stocks. Lupin, positive news there. Vinny joins in.
Hi, Rima. Yes, we are keeping an eye out on Lupin. A bit muted in trade, though opened up much higher, now holding on to gains of almost 0.3% in today's trading session. Lupin has announced the launch of a generic Rivaroxaban, which is a 2.5 mg tablet, which they will be using mainly. And this is an at-risk launch that they've had coming in for the company. So on the back of this, Citi has given a brokerage note buy rating, target price of 2,260 rupees per share. You know, the patent is going to be expiring in 2039. So it's going to be important to watch out for where the litigation actually goes. Currently, a litigation is going on, but yes, they managed to see a launch coming in, that approval coming in from the US FDA, and that is why that launch. Now, according to Citi, this is a $446 million market, may contribute to around $7 to $10 million per quarter initially for the two players that are there. One is going to be Lupin. Sun Pharma is also in the process of this as well, so we'll watch out for competition coming in from Sun Pharma. Nomura too on Lupin is maintaining a buy, target price of 2,350 rupees per share. They're highlighting an estimate market size of around $125 million at a manufacturer price. Overall market size for this drug is expected to be around $2.4 billion, including other strengths. Now, currently, they've only launched 2.5 mg. There are other levels also which could come out in terms of strengths for this drug. And this launch is slightly ahead of the expectation of what the street was expecting. And that is why Nomura continues to be positive on Lupin and maintaining the buy rating.
Thank you very much for that. Time for a short break. On the other side is our special segment, Market Masters. Lata will be in conversation with veteran investor Devina Mehra. Don't go anywhere.
We continue our International Women's Day celebrations, but as before, my guest today is a market master whom we invite for her mastery over markets. That she's a woman, of course, makes it a double delight. Joining me today is Devina Mehra, founder, chairperson and managing director at First Global and author of the very popular book Money, Myths and Mantras, which has gone into reprint in under a couple of months, or in just a month, right?
Just a month, yeah.
Okay. Many congratulations for that.
Thank you.
Yes, here's one reader of the book. Well, I'm going to ask you, begin with a very unique and absolutely unasked question. Has the market bottomed out?
क्या लगता है market, as I say?
Exactly.
Eternal question.
Eternal question.
So,
but now the eternal question has become more persistent because of the slings of the last 4 months.
Yes. So, I mean, again, nothing unexpected. Just this morning, I was looking at somebody had posted the CNBC video from 2009, Nifty circuit up 20% on the...
March of 2009, yes.
Yeah, no, this is that the return of UPA. So Singh is king.
Okay.
And before that, if you go back another 5 years, it was circuit down when UPA came for the first time. So as most things, this too shall pass.
Yes.
But I mean, coming back to the basic question, as far as the large cap mainstream indices are concerned, I think now the risk is on the other side, that if you stay out, you will miss out on the upside. So now you are in that zone. Nobody catches the exact bottom, but definitely you are in that zone. And this is data I've been talking about for the last several years, which is that in 40 odd years of investing, if you miss out on the 10 best days, you miss out on 2/3 of the returns. So if your 100 rupees had become 75,000, now you'll be down to 25,000. If you miss out on the 30 best days, you miss out on 90% of the returns. And it's the same pattern. If you look at the S&P, it will be the same. And so everybody understands the risks of being invested and losing money, but there's also a risk to not being invested. So to the extent, whatever is your equity allocation, which should never be 100%, you should be invested. But the other part of the market, which again, I was looking at least from last July, I've been talking about it, that the small cap, micro cap, and also some other areas where you had these thematic funds, those are the areas which may not come back, because in every bull run and then there is a fall, and the next bull run, it is not the same stocks that come back. And just on the 10 best days, one other thing, that those 10 best days always come when there is fear and uncertainty, where people are asking that should I remain invested, should I stop my SIPs? They don't come when there is optimism and buoyancy and everything looks good, as it was the case in most of 2024.
So it's set. When in your article, I saw the Mint article, stay put or exit, it's clearly stay put, going by the historical
But
evidence.
not necessarily in where you are invested just now. Never wait to make it back in the same stock.
I was going to push this question behind, but let me drag it forward.
Yeah.
I read that bit also. What has just performed very well may not be, will not usually be.
Right.
Now, one of the big themes of the last 2 years have been e-commerce, for instance. I mean, Nykaa, Swiggy, Zomato, they've all given very good returns. Would this apply even to stocks like that?
Yeah, I would not. I mean, this is not where we are invested in the first place. So I may not know the exact details for
I'm just
every
asking
company.
you broadly.
But broadly, yes. I mean, it is. See, people think that one category of themes not returning is stocks which disappear into the blue yonder, as I say. So, because many more stocks have listed over the years than what trade currently.
Yes.
But there's also a category of stocks where the businesses might keep running. DLF being a good example, very coveted IPO, and just it was above IPO price for just, I think, a couple of months after listing, and then didn't see that years, decade plus, it did not see that price. So it is always many of those these stocks that you mentioned are still relatively higher priced if you compare with the global peers and all that. So it doesn't mean that you think the business is going to be a disaster, but the stocks may not still perform.
What are the specific themes we should avoid? We saw defense, we saw PSU. Which are the themes that, you would be wary that it will...
So, I mean, we are fairly stock specific, and I think right now it is also a stock specific market. But in terms of, I will tell you where we are overweight and where we've been overweight for a while, which is IT, pharma, auto components. In the last couple of rebalances, we've added some in FMCG, we've added some in chemicals. Banks, we are still underweight, but we have added some, banks and financials. So that would be broadly it. In terms of what we have avoided, there have been pockets of energy, there have been real estate, we normally avoid also as a high-risk sector, and our systems also never liked it. Paints was another area which we've avoided. So that broadly still continues.
Okay. Well, since you said, auto ancillaries, pharma,
right,
aren't those the ones that could get affected because of the tariff issue?
Yes, I mean, that
you
is,
have, so you would be very stock specific in these areas?
Yes, and I mean, that is, to some extent, the bad news is now in the price. Of course, the way Trump plays it, he announces these tariffs and then he rolls it back. He uses it as a negotiating tool. And if you look at the rest of what he talks about, that the common American has seen their costs go up, and healthcare is, in the US, it is one area which is where US spends the most and gets the worst outcomes. More or less among the developed nations, it has the worst life expectancy, infant mortality, it all, and yet it spends highest per capita. And India has been a source of cheaper medication. So do you really want to tax that?
Mess it up, yeah. I can imagine. So we have, pharma may still stand a chance. Okay, I take your point about being stock specific. The other theme that people are talking about is metals. I mean, one hears it being said because there is a chance that Europe will rebuild, the wars will, Trump is determined to keep wars at bay. Anyway, your view is not a very sexy sector, but has its time come under the sun?
Not really. No, I mean, we don't think it's going to be a really bad sector, but it's not looking particularly great. And I mean, there is a second order effect of Trump tariffs on metals, which is that India itself doesn't export much metal. But if they put tariffs on, let's say, China, so then India becomes the dumping ground. So that's the second order impact which is possible, and which is also keeping us a little wary of the metal plays.
Okay. Well, the other point before I came to the themes, the big question I wanted to ask you is this US exceptionalism and rise of Europe. Is US exceptionalism at an end?
See, first of all, as far as investing is concerned, one thing I say is that no theme lasts forever. No geography, no asset class, no sector within a country, nothing lasts forever. And the US has been an outperformer for the last 10, 12 years. And we were always watching that, when is that going to change? We thought it may be still some time, but I think Trump is kind of hastening the end of US outperformance, maybe. I mean, in our last rebalance.
So it's fading.
Yeah, we've gone not massively, but we've gone somewhat underweight US in our global funds. We've gone overweight Europe. Europe has been doing well, and again, long period of underperformance, maybe that comes to an end. And the narratives always follow. I always say that, like 2003 to 7 is a period when emerging markets outperformed the US massively. I mean, emerging market index went up 3.5 times.
And then the BRICS narrative.
BRICS narrative was, and it's going to be the century of India and China and all of that. And then when US market started to outperform, that was forgotten. So the stories always follow. But US is doing something which is really beyond just investing. I think, they are, and that's the part that scares me, that it is not about investing, but that, the world order as it stood post-World War II is, I mean, there were, of course, many nasty things the US and its allies did in the Middle East, for instance, or even what is now happening in Palestine. But that apart, largely,
based order.
Yeah, I mean, the whole world was kind of balanced, and that is changed. Even on trade, I heard a finance minister say that one thing which has fundamentally changed is that the multilateral organizations like WTO no longer work. We have to have bilaterals with everyone. So many things are changing, and the world peace part is where I am getting a little jittery, that, how does that play out when everybody has their own nuclear weapons and you have dozens of madmen with their finger on the nuclear button.
No, I know. We are not talking enough about it. We are only talking about tariffs, but that is the downside when the rules order changes.
Right. I had posted on this. I mean, that's the scary part.
Yes. Okay, let me get back to economics because people want to hear you about that.
Right.
Which may be the funding economies? If Europe and now even China are the economies to which money is flowing, which may be the economies or markets from which money will go? Will it be India? Will it continue to be India?
See, first of all, I don't spend a lot of time thinking about this, that where will the money come from for Indian markets, because I mean, the subtext to anybody asking that will FII invest or take out money is that if FIIs invest, the Indian market goes up. If they take out money, the Indian market goes down. This time it has been coincident that yes, they sold and the market went down. But if you look at the long-term data, there is no correlation. I mean, that's something we monitored for a long time and we found there is no correlation. And this is right from the beginning. I mean, the FIs started investing in 1994, and 94 to 2003 is the only 9-year period in the Sensex history with a net zero return.
Oh.
So there's like that much money which came in. There was no domestic mutual fund or institution to speak of other than the UTIs and LICs. And yet that money did not drive the market up. So it is, there is a disconnect.
That's a big consolation for people who believe that markets will run only with FII money.
No, that's the data. Yeah. I mean, that's
fair point. Fair point. No, the reason why I asked you was not whether FIIs will come in, but will the pull-out continue? If, China and Europe become the go-to market, okay, as you said, some money you pulled out from US and put it in Europe.
Right.
Will FIs continue to use India as the funding market to fund their new investments in China?
I don't think that's the real reason. If at all, on the margin, FIs, if you look at one, of course, is rupee depreciation. So their dollar returns have been coming down. And if you are making the returns, then we have a capital gains tax, which other markets don't have. So on the margin, you can say those are the factors.
Okay.
And so I don't think that to invest in Europe necessarily, that they might take money out of US for to invest in Europe.
Yes, we hope that. We hope that US exceptionalism will not draw money, at least from our country. If it is fading, then that much may be good news. We don't know. But thank you very much, Devira Mehra, for the fund of themes and topics within India that you have discussed with us. It's a pleasure having you with us, and we will, of course, have you even after the International Women's Day theme is over. And many congratulations on your book.
Thank you. Thank you.
We have to wrap up this conversation on that note. Chartbusters coming up after a break.
IndusInd Bank opened sharply lower as the RBI approves only a one-year term extension for MD and CEO Sumant Katpalia versus an ask of a three-year extension.
Shares of Omax trade with gains as it launches a new phase of its world project in Faridabad. The estimated value is around 600 crore rupees.
Gensol Engineering opens with cuts as promoters sell about 2.5% stake to reinvest in the company's business. This is contrary to the management's comment on CNBC-TV18 just last week, stating that promoters would be looking to buy stake in the company soon.
Hyundai Motor India dips more than 1% after the company seeks shareholders' approval for 7 material related party transactions worth more than 31,000 crores. We'll discuss this in greater detail during the course of the show. Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel and with me is Mangalam. And as you can see, we are pumped up post yesterday's win. The men in blue, well, Mangalam, they drove home the advantage. And what a sight to see, right? The boys doing a bit of a jig post the game. Sunny Gavaskar couldn't control himself as well. Good times.
Good times indeed. And I see you wearing a blue jacket as well with the orange tinge out there. Reminds the color of the jersey of the team. We can't wear the jersey of the air. Might as well wear the same color as the Indian cricket team itself. We called it the Motilal Oswal studio at the top, but this is again, you know, the stadium that we've created in our little CNBC TV18 studios itself. Those are the champions. What a team it is. And the good part is that there was no retirement that was announced by either Virat Kohli or Rohit Sharma as against what the most were expecting this time around. So good on them, man. What a camaraderie, what a team, what moments. What
well, that's right. ROCO, right? They continue to play and that's good news. And, you know, Mangalam, what's good is that you can see continuity as well. The next gen is up to the challenge. They have been, being taken care of in the able hands of Virat as well as of Rohit and champions, so to call it. Great game, pumped up. And it ended pretty okay as well. So we got our required hours of sleep.
We did get our required hours of sleep. And, just to wrap this up, ROCO in Hindi is to stop.